All right, gives me great pleasure now to bring on board the Mr. Maverick of Indian stock markets, Samir Arora. Samir, good morning. Thank you for joining
Hello.
us.
Hi. Good morning.
How are things?
Things are good, and Maverick was the biggest hit of the last 3
That's why I
years.
called you Maverick. That's why I called you Maverick. Your fund's doing so well that we should call it Maverick.
Very good.
Did you see the movie?
Yeah, of course. That was a long time ago. I've already seen it after that on OTT a second time.
At 55 plus, Tom Cruise can do that.
I
All
think
those
he's 60.
stunts. He's 60.
I think he's 60, I think.
So we saw a magic trick from you last time,
But you know,
Samir.
right? His latest movie is not Maverick, it's Mission Impossible.
Yeah,
No,
of
no,
course.
Mission
FYI.
Impossible also.
Yeah.
But the Maverick was the name of the previous Top
Yeah.
Gun.
Yeah. Yeah, you were saying?
Y'all
No,
want
no,
to
no.
discuss shows or the market?
No, okay, we'll talk markets. But right now, I'm just,
Okay.
every time Samir comes on the channel, you got to talk about so many things. So, Samir bhai, last time we requested you for a magic trick.
No, but you have to tell me before. If you had told me yesterday, I could have come to office with one. I have a few here and there, small ones, but I'll send them via Twitter.
So, next time we look forward to a magic trick from
Okay.
Samir. Okay, so you have to shake your magic box and take out a stock tip, which could be a trick for everybody. What would that be for the day?
No,
That
we
you can
don't
do
do
right
like
now.
that.
You don't need to prepare for that.
We are a regulated entity. We only talk of big picture.
So let's talk about the big picture. And the big picture is that flows have turned and flows are looking very strong. When you speak to some of your investors and your LP associates, are you getting a sense that the liquidity reversal which has happened from April onwards, it's real and it's here to stay?
100%. And let's not call it liquidity reversal because the previous trend was only like odd in some sense, although it happens every now and then. But generally, FIIs are buyers. As in the last 20 odd years, they would have been buyers in maybe 16 of those years. Now the story is on two legs. One leg is that people are, say, frustrated with China or whatever, and they have really done badly investing there. And the second is that separately, India has a good story to tell. We don't want it to look like a story that we are getting money because you guys don't know what to do with your money now that you find China unattractive. But that, hey, separately, India was doing well. You wouldn't notice it for 2, 3 years. Actually, India's done well over last 5 years, 10 years, 15 years, 20 years, and 25 years in dollar terms. But okay, now you are having these two parts of the story, and that is why this, I think, will continue for a long time or reasonably medium time.
So what happens now? Flows are strong and markets are perhaps fairly valued. So are we likely to see a situation where excesses will get built up?
Well, first thing is that it's fairly, most of the time you're supposed to get fair value only, because when the valuations are too attractive, then mostly it is happening because the flows are scared. So here the simple story is that we have had in the last whatever number of years, if you take a slightly longer period, about 13-15% INR returns. And here for year to date, it is maybe around 9-10%. So it's not way out of line with an annualized number of 15 odd percent. And secondly, if you also add last year, then the number is actually much lower because last year it was sort of flattish. And if you took it in dollars, it is still lower than maybe what it was in December 21. And during this time, India has done a few things which make it relatively a good place, whether it is to do with inflation or the fact that our current account deficit is reasonably low so that we may going forward expect a lower devaluation. And that we have done these 2-3 other things, that our fiscal deficit is not so out of line because we didn't spend so much money post-COVID to stimulate the economy. And in this meantime, you got more frustrated with China and the US has done well, so on and so forth. So for some time, you can get a little bit more than fair value. When a fair value comes, it is because there have been periods of undervaluation or whatever is the word, and overvaluation. So fair does not come just that, okay, fair and the story is over. You have many periods where it could be a little bit overvalued, but why should it be? The earnings growth for most of the companies are coming out okay. So if you get that earnings growth in the price or in the market over 1 year, that is also a good enough return. We don't need to re-rate the market.
Samir, you're not doing magic right now, but you've done a lot on Twitter, reading about your tweets on inflation, concentration, and even AI. And I'm just curious with this digital adaptation, how you're looking at a lot of these global tech stocks versus what we have back home. We know, of course, about your investments, but just curious as to how you see the overall story now play out from here on. So many IPOs as well. Has anything caught your eye?
So in the IPOs, we normally don't buy because these IPOs, if they are good, they get oversubscribed so much. But some of the IPOs, including this drone guy, I think is super highly overvalued. Let's see. I would think that some of these should fall 50, 60% before anybody should look at them. But it will be a good test of how much speculation we can do in life, because of manufacturing companies, valuation is not supposed to go up 10 times over a 10, 12-month period, as if during that 10-month period, somebody discovered a cure for cancer by mistake while doing some simple manufacturing. Normally, these very steep changes in valuations can happen if you discovered some magic formula along the way. Otherwise, you were supposed to make X machines and you made X plus 25 machines. You're not supposed to have valuations up 10 times because willingly 10, 12 months ago, you raised money at 1/10 the valuation. So I just, big picture, I reject those things. On this US tech versus Indian tech or whatever, the US tech also, if you see, the guys that are going up are seen as direct beneficiaries of AI, or companies which is like Microsoft types, or companies which cut costs and went back to focus on what they were doing and gave up on their bigger projects like Meta or even Google. Or Alphabet, that is. So those stories are a bit different from our story, where in India we want the world to be doing new things and more things. And AI may actually, for us, be maybe neutral-ish in the beginning, but in the end has to be negative. But more than that, my idea is that all these companies are saying that we have poor results currently, but in future we have a lot of business we can see in the future. Because many clients are interested in bigger projects. So I can't reconcile to that a company is saying to its service provider that, hey, I don't want to do any business right now, but here, take this big order. So what that means is that the big order most probably is of a different kind, which means it is like a cost takeout kind, which somebody is committing. But those projects by their nature are lower margin. And because they are longer term, by definition, even somebody giving you a 7-year order instead of a 5-year order in writing will want a discount for the fact that he's committing to you a bigger order and a longer tenure order. So in the end, this might be good, but right now, every one of them is disappointing, and every one of them, the stock price is going up, and we don't like this thing.
Samir, we got a unique listing today. When I say not listing, but a price discovery of Jio Financial Services. What do you think would be the medium to long-term implications of this? Because Reliance is giving birth to a business which is backed by technology, which is backed by scale, and they have advantage of data and reach. What implications do you think this could have on the lenders, the distributors, and even for that matter, platform companies like Zerodha and Policy, PB FinTech?
So I don't know much about how it will make such a big difference to Zerodha type, but to the financiers it will, because these guys are themselves selling 50, 60% of smartphones or phones, and they are selling their own televisions and everything else through their own network. So easily they can bundle financing along with it and directly say to the guys that if you are approved and you are on my list, then this is your price straight away. The customer doesn't even have to make a separate thing of first buying a phone, and then even if it takes 1 second to find a financier on an app, that can come packaged in, that we will just check your name, and if your name is on our list, you can have it. So it'll make a big difference. The only thing is that right now we didn't know how to value it on a price to book, because their book has a lot of Reliance shares in it. And so should we treat it like cash? Because if it is like cash, then you earn some 6-7% on it, and that can be another support to the stock price in terms of many years of other income. But if it is in form of share, then that became confusing. So we are also seeing how this price is discovered, and then we'll decide what to do.
As a long haul investment, do you think this could be one of those stocks which institutional investors would like to own for next 5-7 years?
I think over time, 100%. Over time. It's just that in the beginning, if it gets treated like a finance company already in business and the price to book is high, then we might back off for some time. Yeah, let's see.
Current juncture, after the run up of about 15% on the Nifty, 20% in mid and small cap stocks, 25 plus actually in small cap stocks, what would you say is the most overrated sector and the most underrated sector?
So first of all, it is wrong to look at it as a 20% rally. You should look at it year to date, which we mean by that calendar year to date. The market is up 9%, which is in line with a normal good year. How I say that is that if the market is up normally 13-15% per annum over a cycle, that cycle has some positive years and some negative years. Mostly the negative year which comes is a big bad year, like you are down 25-30%. And then that year is so bad that it takes away the returns that somebody made in the previous year. And therefore you make 5 years returns over 7 years. I mean, it comes out over 7 years, let's say a cycle of 8 years. So in the good years, you're supposed to make more than 14, 15. That is how the annualized number over the good and the bad years will come out to be that. So right now, it is in line with a normal year, following actually a bad year. So nothing is there. Now, in terms of overvalued and undervalued, we thought that this quarter that the IT results will be bad and the stock reaction will be bad, and then we would have felt a little bit tempted to buy it, saying maybe all the news is out there. But the reaction of the market made me feel that I can just continue with what I have, which is to continue with financials and consumer and ignore IT, because I have a certain framework, and that framework, I don't believe that the Indian market discounts things 2 years ahead. We can keep acting as if we are long term. But for us, it has worked for 26 years or 27 years. Results are bad. This year is bad. Next year is okay, but these stocks are not so cheap that you buy and forget them, saying, they are like in the dumps, so just let me buy them at a bad time. They are still trading at higher than market valuations for numbers which may turn up in the second year, for which a bet can be taken, but only if they are trading well below their average. Otherwise, what is average if everything is average or above average? If the valuations are average, then sometimes those valuations are below average, and we want to know when are they below average. They should be in these situations. So therefore, for us, the sectors will remain the same.
So Samir, you're sticking to
Financials
you're sticking to financials, you're sticking to consumption. Why don't we talk about one of the largest holdings there, HDFC Bank, now with things having changed with the Mammoth merger? What's the outlook?
Well, we have it forever, so our story doesn't change. It needs a little bit of a sort of a cleanup or new people coming in. But if we think that foreign investors are coming into the market anyway, that the foreign investors are, as we said, the flows are coming in, they have no choice but to also buy HDFC Bank. It's in their index now at 6-7%. But more than that, it is easy for them to justify buying it because they'll say it has underperformed for 2-3 years. And everybody who comes in buys 10-20 stocks, so literally every new fellow will have to buy it. Similarly, nearly every new money raised in India in mutual funds will have in their benchmark 10% or whatever in this bank. So unlikely that not everybody will have 8-10% or 6%, but nobody's going to have zero. So even if you say 7% of every new money raised in the mutual fund industry in these big flexi cap, this cap, whatever cap, has to go in first by HDFC Bank, it'll sort itself out. Fundamentally, it's anyway doing well. Therefore, I don't worry about currently if somebody has to sell because it is more than 10% and all that. Over time, there will be enough flows into it. And fundamentally, everybody agrees that it is doing well for the last 2-3 years. Also, it has done well and become cheaper during this time. And that is an easier one to say buy and forget.
Samir, now financials is a core for everybody. It's a matter of whether you are 30% or 35% or 40%.
Correct.
And rarely we've seen that consensus of this magnitude really creates a strong outperformance. But you also like financials. So what's the underlying thought here?
So I will tell you, first, it has not caused outperformance this year. It did not do it in 20. It did not do it in 21. If you see the bank index, it was at that time PSU banks which did well. And even in 20, I think, because I remember writing that our top weight, the index did worse than the market, but we did better because we had ICICI Bank and State Bank. But as an index, it did not. Secondly, for how many years have we known that in India is a story of IT and banks? Forever, right? Banks we have known because they do better than than state-owned banks was a story for 20 years. It worked for 20 years. IT, forever we know that IT India is cheap and, that people come to India, and forever we knew it, and forever the stocks did well. If you look at it from 90s, only the same story. Never has the story changed in either IT or financial. So the point is these things, everybody consensus, there's no sick. For how many years have we known that Google is a monopoly in search, and literally forever Google has outperformed? If you see all these new guys who talk about buying only the successful companies, everybody knows they are successful companies, and you buy them and you still do well because you have to bet on their delivery part. You have to bet on their longevity part rather than on everybody believing. Plus, as I said, I don't believe that everybody who has to buy has bought it simply because we are whole betting on the fact that now there'll be new FII money, which for around 18 months, that is half of 21 and 22 together, I think some $35 billion were sold by FIIs or something like that, in which 30% would have been financial. So they would have sold 10 billion, of which they would have sold 2-3 billion of HDFC Bank, which is why HDFC Bank foreign ownership went from some 73 or something to 60, which is why everybody was betting that it would come into the MSCI index. So if it was consensus, right now State Bank is down for 6 months and HDFC Bank is up, I think 1% for 6 months. And the other one, ICICI Bank, it's up 3% or whatever. And ICICI Bank is up 9% in 6 months or whatever, 6.5 months. So nothing to worry. It is if the numbers come, if the environment is for them, then whether you are consensus or not doesn't matter, because more people are to join and be beyond a point. For 7 years, for example, from 2013 to now, HDFC Bank was not in the MSCI index and foreigners were the main buyers, and it was removed from the index. It used to be 7.5% and still it outperformed.
Okay.
Even including those last 2-3 years that it has not.
Great, Samir. Always a pleasure having you on board and getting your views on the market direction as well as stocks. Magic tricks next time. We're booking and blocking our dates from now.